Right. Okay. Good evening.
Good evening, sir.
Good evening, sir. Good evening, sir.
Good evening. Right. Okay. So last week we discussed equity valuation. So equity valuation we discussed almost all the points. So there are few more questions to discuss. So we'll complete equity valuation part so that we can move to the new topic. Right. So equity valuation, we discussed equity valuation. The principle is similar to the valuation of debt instrument, but in equity valuation, the challenging part for the analyst is to estimate all the values. We need to estimate, and the equity valuation entirely based on estimate. So we discuss what are the values that should be estimated, and what are the main challenges we have to face in estimating these balances. And also, we discussed there can be different types of assumption, because when we are going to estimate, we need to make some assumptions, and the assumption related to the key variables we can make in different ways. Especially the assumption related to the dividend growth rate. One of the most important assumptions that we need to make in equity valuation, uh, the assumption related to the dividend growth rate. So that we discussed three main types of assumptions, and we discussed about the zero growth in dividend and constant growth in dividend, and then we also discussed the detail, the method of the non-constant method of non-constant growth in dividend, right? Non-constant growth in dividend. So we discussed these three main assumptions. And when we use the assumption that the dividend is growing at zero rate, that means constant dividend, then the future benefit take the form of a perpetuity. So since the price is the present value of the future benefits, it takes the present value of a perpetuity. Very simple. But when we use the assumption that the dividend is growing at a constant rate, then we have to estimate that constant growth rate. So we discuss what are the main approaches used in estimating the constant growth rate. And after that, the more detailed method is to assume that the dividend is growing at a non-constant rate. So non-constant growth in dividend, we discuss even if we can use a general definite model for the zero growth and constant growth model, right? But for non-constant growth model, the non-constant growth in dividend, that assumption, we can't use a single formula, because that when we use that assumption, there can be very different types of estimates. Sometimes two growth rates, three growth rates, right? Any number of growth rates can be there, and different amounts of dividend, expected dividends may be there, right? But at one point, we discuss it is necessary to assume the dividend is growing at a constant rate. So that's why even if we use non-constant growth in dividend assumption, at one point we have to use the constant growth in dividend assumption. So we discussed when we have to apply the constant growth model at any particular point, what is the principle, what is the basis of doing that. So we discussed we have to uh, apply the constant growth model at a particular point. So we discussed one example last day. So according to that example, constant growth start from the fourth year. Then we discuss the principle. If the constant growth starts from a particular period, we need to apply the constant growth model to that year. When we apply the constant growth model for a particular period, we get the price at the beginning of that period. So that's the main point we discussed. If the constant growth starts from the fourth year, when we apply the constant growth model to the fourth year, we get the price at the beginning of fourth year. Beginning of fourth year means end of third year. So that's why we discussed it is P3, and it is P3. And based on that, we discuss how to calculate the share price, right? How to estimate the share price, we discuss, right? Okay, that other detailed question I just mentioned here, I think so. You may have done that. Did you manage to do that question? Is it necessary to discuss today, or did you do that? right? Will you do that, or you want to discuss it now? Right, the question related to this problem solving exercises, we have done question number 1, 2, and 1, 2, and 3. No, 3 we didn't do, right? So 3 we didn't do, and because to discuss question number 3, we have to discuss one more concept relating to these investments and valuation of financial assets, right? So question number 4 is question number 4 in page number 28. So that for this one,
E-
right? So this question number 4 in page number 28. So I mentioned, right? So this is the question number 4, page number 28. Right. So there are, right, this question number 4 in page number 28, right? We discussed the key points. We discussed the key points, right? And right. So did you manage to do that? Did you do that, or shall we do it? Yeah, can you hear me, please?
We can hear you, sir. Can hear you, sir.
Right. So did you do this question, or shall we do it? Or? Did you do the question? Did you do this calculation?
We'll do the question, sir.
Right. Okay. Okay. This is the question number 4 in page number 28. Yeah. The information given relating to the estimate for a particular company. So which company currently pays a dividend of 20 cents per share. So that means it's not the expected dividend, it's currently paid, right? So they have paid, that means that is D0. D0 is 20 cents, right? That means $0.2. Right? So this is D0, and this dividend is expected to grow at a 15% annual rate for 3 years. So here actually 15% annual rate for 3 years, then a 10% rate for the next 3 years, and after which it is expected to grow at 5% rate forever. Right. So 3 growth rates are there. So it's necessary to identify this information clearly. Right. The first of all, so they have estimated the dividend will grow at a rate of 15% per annum. Right, 15% per annum for first 3 years. Right, first 3 years. First 3 years, and then the second growth rate, 10% rate for the next 3 years, right? So that means the second growth rate is 10% per annum, right? 10% per annum, next 3 years. That means from 4th to 60th, right? 4th to 60th. Year 4, 5, and 6, right? The growth rate is 10%, and and after which it is expected to grow at 5% rate forever. Right? That means the third growth rate, 5% per annum, 5% per annum, right? That is from which year? From
Year 7 to
7th
18.
year.
from 7th year, right?
Seventh year.
From 7th year, the growth rate is 5% from 7th year. That means that is the constant growth rate, right? From 7th year, right? From 7th year, forever, right? So that means that is the constant growth rate, constant growth rate, right? The question is, what value would you place on the shares if the 12% rate of return was required, right? 12% return were required. So that means the required rate of return is 12%. The required rate of return is 12%, right? If that is the case, what is the price you are willing to pay? The question is, what is the price you are willing to pay? That means we need to calculate P0. We have to calculate P0. So this is what we have to do, right? All the information we can identify clearly. The information given clearly. The current dividend is $0.2, and the dividend estimate, dividend estimates given. So that means they have estimated the dividend will grow at 15% rate for 3 years, 10% rate for next 3 years, and after that 5%. Right, that is the constant growth. And then we need to calculate the price if the required rate of return is 12%. Right, I mentioned last day. So we don't need to worry about the number of growth rates, right? The number of the estimates given. So if there is a possibility to estimate for a long period, it's better. But that is, as we discussed, usually challenging. I mentioned last day, normally for equity valuation, we don't make estimate for a long period like this. But this is a good question to understand equity valuation concept, right? Okay, now this information given. So what we need to do, we have to estimate the future benefits based on this given information. Right? After that, the calculation of price is not difficult. Right? We know since these estimates are given, since these estimates are given, and we know these first 3 dividend, right? First dividend we need to estimate at which rate? These first 3 dividend we have to estimate at the growth rate of, right? You see the growth rate of 15%, right? For these 3 dividend, the growth rate is 15%, and then we have to estimate the dividend for the next 3 years. Next 3 years, that is right. Sorry, D4, D5, and D6 we have to estimate using the growth rate of 10%. Right, the growth rate for this one should be 10%. Right, after that we have to apply this constant growth model, and from this point the growth rate should be 5%. That's all, right? So it's not a difficult question, right? Only thing, once you identify these inputs correctly, it's not difficult to do this calculation, right? So here, as we discussed last day, the best thing is to calculate these benefits separately. It's not essential. You can apply to the formula itself, but so we can easily do this calculation, right? So we can calculate these values separately, and then we can use with the formula, right? So it's not difficult to calculate these values. So let's calculate. We need to calculate D1. And how do you calculate D1? D1 equal
D0 into 1 plus G.
D0 into 1 plus G. D0 into 1 plus G. So D0 is given. D0 is 0.2, right? It's a 0.2, and the growth rate, right? The growth rate for the first 3 years, 15%. Therefore, it will be, right? It will be this, right? It's 0.2 into 1.15. 1.15, right? That means what is the value of D1?
0.2823.
0.28. Okay, 0.23, right?
Yes, sir. 23.
Yeah, 0.23. And then we can calculate D2. D2 equal D1 into 1 plus D. D1 into 1 plus D. And D1 you already calculated 0.23 into 1.15. Right? It is 1.15. Right? What is D2?
0.2645.
0.2645. And then we can calculate D3. D3 equal D2 into 1 plus G. 1 plus G. So D3 you have D2 you have already calculated 0.2645 into 1.15. Right? What is the value of D3?
3042.
0.3041.
3042. Right? Okay. Yeah, 3042. Right. Then D4 equal D3 into 1 plus. Right? D4 equal D3 into 1 plus G. 1 plus G. So D3 you already have calculated 3042 into 1.10.
10.
1.
Yeah, 1.1 because from the fourth year growth rate is 10%. Right? That means what is the
3345.
yeah? So it is 3345. So 3346. Right, and then you can calculate D5. You can calculate D5. So D5 equal D4 into 1 plus G. That is 0.3346 into 1.10. Right. So what is the value of D5?
0.3681.
Point
3681.
3681. Right. So it is 0.3681. And then we can calculate D6. D6 equal D5 into 1 plus G. 1 plus G. So D5 you already calculated 0.36881 into 1.16. Right, that is D6 equal
0.4049.
4049.
4049. And it is 0.4049. Right, then we have to calculate P6. We have to calculate P6. P6 equal, right, we know it is D6. D6 means D5 into 1 plus G, D5 into 1 plus G divided by R minus G, R minus G. R minus G. Right, so D5 you already calculated, D6, sorry, here, D5 or D6?
Six.
D6 into 1 plus G, because, right, if the constant growth start from the 7th year, here constant growth start from which year? The constant growth start from 7th year, right? First 3 years one rate, next 3 years another rate, and the constant growth start from the 7th year. If the constant growth start from the 7th year, what is the dividend value we need? We need D7, right? So we discuss if the constant growth start from the first year, we need D1, right? Here we discuss the constant growth model, and based on the constant growth model, if the constant growth start from the first year, we need D1. And how do you calculate D1? D1 means D0 into 1 plus G, right? And when the constant growth start from the 7th year, we need D7. And how do you calculate D7? D6 into 1 plus G. So D6 you calculated, it is 0.4049 into, right, 4049 into 1 plus G, 1 plus G, that is 1.05. 05, right? Because it is the constant growth rate, and that should be divided by R minus G. The required rate of return was given, it is 12%, minus the constant growth rate 5%, right? Then you get the price. Right. What is the price?
$6.0885.
It is 6.0885.
0885.
Right. Is that correct? Others got the same answer?
Correct, sir. Same answer.
Right. It is 6.0729. Is that correct?
Yes, sir.
Right. So these are the values. Now we need to discount. We have to discount. Right. 0.230. We need to discount at 12% for 1 year. 1.112 to the power 1. To the power 1. Right. It is 1.12 to the power 1. Then D2 should be divided by, right, 1.12 to the power 1.12 to the power 2. Then D3 should be divided by 1.12 to the power 3. Then D4 should be divided by 1.12 to the power 4. And D5 should be divided by 1.14 to the power 5. And D6, that is 0.4049, should be divided by 1.12 to the power 6. And then you calculated P6. P6 equal 6.0729, and that should be discounted for how many years? That should be discounted for
6 years.
6 years. 6 years, right? Okay, so that is how we calculate, that is how we have to calculate the price. Right. Right. So when you discount this and get the total, so that is the price, right? Fair value for this share. Right. 0.23, when you discount at 12%, what is the answer? What is the value?
2053.
2053. Right. So it is 0.2034. Right. And D2, when you discount, what is the value?
2108.
2108. Right. And then D3,
2381.
is it 2381?
2165, no?
2165, right? It is 2165. And D4, when you discount at 12% for period, what is D4?
2126.
Right? And D5 discounted at 12% for 5 years. It is
2086.
2089.
Okay, 20, right, 8, 8, right. So then D6, 1.12 to the power 6,
2051.
2051. 2051, and you, right, then you need to discount the share price, expected selling price at 12% for 6 years.
3.076.
It is
3.0767.
3.0767, right? So that is correct. So then when you get the total of these values, that is the fair value for this share.
Sanjeeva sir,
Yeah.
sir, I'm sorry, the last part, why are we discounting it by 6 years without taking 7 years?
No, that means when it's a growth, this constant growth start from the 7th year. Yeah, this is the the calculation we did with respect to 7th year, but we apply the constant growth model to the 7th year. When we apply the constant growth model to the 7th year, we are getting the price at which point? At which point? Now in this example, constant growth start from the 7th year. When you apply the constant growth model to any period, you are getting the price at which point? With respect to that period, you are getting the value at the
End of the previous year.
no, actually we are getting the value at the beginning of that period. For example, this is the formula we use assuming the constant growth start from the beginning. So when we assume there is a constant growth in dividend from the beginning, only one constant growth rate. When there is only one constant growth rate, right? So when we assume the dividend is growing at a constant rate from the first year, from the beginning, right? That means the constant growth start from which year? From the first year. First year itself, the constant growth start. When we apply the constant growth model to the first year, we are getting the price at which point? We are getting the price at the beginning of the first year or end of the first year?
Beginning.
Beginning of the first
We
year.
are getting the price at the beginning of the first year. When you apply the constant growth dividend model to the this constant growth formula, we are getting the price at the beginning, P0. So here, first year, the constant growth start from the first year itself. When you calculate, we get the present value, that is the price today. And in this example, the constant growth start from which year? Constant growth start from the 7th year. And when you apply the constant growth model to the 7th year, you are getting the price at which point? At the beginning or at the end of the 7th year? At the
Beginning of the 7th
at
year.
the beginning of the 7th year. Beginning of 7th year means what?
End of 6th year.
End of 6th year. Beginning of 7th year means, is it necessary to discount for the 7th year also?
No, sir.
No, because beginning of 7th year means you don't need to discount for the 7th year. Beginning of 7th year means end of the 6th year. Right? So that's why when the constant growth model start at any point, right? The constant growth can start at any point. But when you apply the constant growth model to at any particular period, you are getting the value, you are getting the price at the beginning of that period. Right? You are getting the price at the beginning of that period. So when the constant growth starts from the first year, when you apply the constant growth model, you get the price at the beginning of the first year, P0. And when the constant growth starts from the 4th year, in this example, when we apply the constant growth model, we are getting which price? We are getting the price at the beginning of 4th year. Beginning of 4th year means end of 3rd year. And if the constant growth starts from the 7th year, right? So we apply the constant growth model, we are getting the price at the beginning of 7th year. Beginning of 7th year means end of 6th year. So that's why we need to discount only for 6 years.
Thank you, sir.
Right. And then when you get the total, because the price is the present value of future benefits, all the future benefits you need to add, and what is the price you get? What is the value, fair value that the consumer is willing to pay for this product based on the current rate estimate?
4.3354.
Sorry, 2 point?
4.34.
4.3357.
Okay, 4.33, right? So 4.34. So even 2 decimal points sufficient, right? So even 2 decimal points are sufficient. So as you mentioned, 4.34. That's correct, right? So the price we are getting is $4.34, right? So we are willing to pay, right? The price we are willing to pay to buy this product is $4.34. That is the price, right? So based on this estimate, the price consumer willing to pay, investor willing to pay for this product is $4.34, right? So here, as I mentioned, normally we don't get some estimate for this number of low period, which is quite challenging and not really realistic under the current market condition. So it's to estimate for 7 years, that's not possible, right? But here, as I mentioned earlier, good question to understand the equity valuation process right now. So based on these future benefits, if the investor require a return of 12%, the price he is willing to pay for this share is 4.34. This is the fair value according to the current according to the estimates available with respect to this firm, right? Once you calculate this, even you can use the discount factor and calculate the present value. If you are going to use the discount factor, right? How do you calculate the discount factor? Because here we need the timing of these cash flows. Right, and if the discount rate is 12%, so even you can put the, when you are doing this in Excel, that's fairly easy. So you can put the discount factor here itself, 1 divided by 1 plus I, right? 1 plus I here, discount rate is 12%, to the power, right? To the power this period, right? Since okay, so that is how you calculate, and that should be multiplied by, right? So these future benefits should be multiplied by the discount factor. So they are, you will see, you are getting exactly this answer, right? So you can calculate this discount factor using Excel easily, and when you calculate this, so you get the you will get these prices here: 0.212909, 2165, 2126, 2088, 2051, and here all the values you can get easily in Excel, right? So it's matter of getting the required rate of the discount factor, so which you can easily calculate in Excel without any statistical table, right? And after that, we need to get the total of this column, so which is the amount you mentioned, right? 4.34, right? 4.34 is the present value of these future benefits. The price the consumer is willing to pay is 4.34 according to the current estimates. Okay, right. That is how you can estimate what value would you place. So that's the price. That's the price. So if the current market interest rate is 12%, so you are willing to pay $4.34 to buy this stock, because you think that the current market estimates this share worth this much, 4.34. Right. Okay, so here another point is there in that question. Would your valuation change if you expect to hold the shares for only 3 years? Right. Okay, that's another question related to that same question. Another sub question. Would your valuation change if you expected to hold the shares for only 3 years? Right. Instead of holding the share for 7 years, if you are planning to hold the shares only for 3 years and sell, right? Would your valuation change? So this is the price we estimated based on this information. The question is, would your valuation change if you expect to hold the shares for only 3 years? You are planning to buy this share, hold it for 3 years and sell. The valuation, that means the amount you calculated here, will change or no? Will change or no?
It will change.
Sorry?
The value will change.
The value will change. Any other answer?
No, so value doesn't change because because any time you sell it, so you sell it at same.
Yeah. The point you sell, yeah, maybe different. So you can sell this, right, according to this second point. You are going to hold the share for 3 years and sell. What happened to this price, this valuation? So this is the valuation you make, right? This will change or no?
It will change, sir, because if you
I did not
sell
change.
it at the third year, you will lose the dividend cash flows for the next couple of years that you have used for this calculation.
Any other view?
It won't change.
Yeah.
Exactly, it won't change. So
Sorry?
Because holding the share, it's our choice.
Okay.
So since you have discounted the cash flows for P0,
Yeah.
it will not change.
Right. Okay. So there was another, idea. So so you mentioned right, another idea was there. So but there also you mentioned it will not change. So you try to you try to explain another point. What is that? The holding the share is our option, right? That's correct. So the point is correct. So can you explain it further?
So though we hold the share or not, based on the market information, the price won't change.
Yeah, holding the share is the investor's option, right? Investor can hold the share or sell it, right? But the market price will not change based on the holder, right? The market price of the share, sorry, the fair value of the share, fair value of the share will not change based on the holder of the share. The market value, the fair value depends on the information, the estimates, right? Whether we hold this share or not, these estimates will not change. Now these estimates are there, right? So we may sell this share at the end of the second year or third year, fourth year, whatever it is. Whatever the point we are selling the share is not a factor that will affect to the price, right? So now when we are going to, these principles applicable not only to the financial asset. Suppose we are going to buy current, we are going to buy a property, right? The building. So when we estimate the price today, what is the fair value for this asset? We may have, we may have different plans, right? Different investors may have different plans, right? But based on our plan, the fair value of the asset will not change, right? The whole, as you very correctly mentioned, holding the share is our option. So, right, whether we are going to sell the share at the end of the second year, third year, fourth year, that's our option. That will not affect the fair value. The fair value, right? These are the estimates. These are the estimates. These estimates will not change whether I am the holder of the share or you are the holder of the share. These estimates will not change. So the share price will change only if this growth rate change, the required rate of return change. So right, but as long as the estimate same, it is not important the point we are going to sell the share. When we are going to sell the share at the end of the third year and fourth year and fifth year, selling prices will be definitely different. But what is the value we calculated? We calculated today's price. Today's price will not change based on the point we are going to sell the share. So we can check this. We can check this. Yeah.
Sir, can you calculate whatever time, then see what will happen to the fair value? So
Yes,
please calculate and
definitely.
see.
Definitely we can check. We can check. Now if we are going to sell the share at the end of, right, so we will see this and we'll check this. Suppose we are going to, right now, as it was given in this question, if we are planning to hold the share only for 3 years, right, that means Now, to calculate the price for the share, what are the values you need? Right, you are going to hold the share for 3 years and sell. Then what are the benefits you are going to get? Because price is the present value of future benefits. Because that principle will not change. Price is the present value of future benefits. Now you are going to buy the share, hold it for 3 years and sell. What are the benefits you are going to get? What are the benefits you are going to get?
Dividends plus
Dividend.
capital gain.
Yeah, dividend for how many years you are going to get? Dividend you are going to get for
3 years.
3 years. At 3 years, and then you are going to sell the share. That means what is the selling price you need? You need the selling price at the end of
Year 3.
year 3. You need the selling price at the end of the third year, right? Year 3. And that means, right? So that's very correct. So we need to calculate the share price under that assumption, that estimate. We need D1, D2, D3, and also we need P3. We need P3, right? We need P3. So we are going to sell the share at the end of the third year. And which should be discounted? It should be discounted for how many years? Should be discounted for 3 years, right? We have to discount that for 3 years, right? Then, right, so that means to calculate the share price under that assumption, these are the values you need. Then now we know D1, D2, D3. D1, D2, D3, you have already calculated and even you have discounted. So this information we already have, right? Nothing to worry. So this information we have. Right? We have the information D1, D2, D3, we have already calculated and we have discounted also, right? Therefore, no issue. The information there. But we need P3. We need P3, right? We need P3. And how do you calculate P3? Right? So we need the P3. How do you calculate P3? Right? How do you calculate P3? If you are going to sell the share at the end of the third year, how can we identify what is the price you are going to sell the share at the end of the third year? We need P3 now.
You have to discount D4, D5, D6, and also discount the perpetuity from there on.
Exactly. You know, at any point, price means what? At any point, price is the present value of the future benefits. The person who is going to buy the share at the end of third year, he is paying for what? He is paying for the benefits he is going to get. Right now, we are going to sell the share at the end of the third year. The person who is going to buy the share at the end of third year, he is going to pay a price to the current shareholder. What is the price he is willing to pay? He is willing to pay the present value of future benefits. You know, now the shareholder may change, but the estimates related to this company, and this company dividend will grow at this rate, right? So these estimates are there. So these, when we estimate certain, when you estimate certain value for a particular company, the estimates will not change whether I'm holding the share or you are holding the share. The estimates will be same. So therefore, the person who is going to buy the share at the end of the third year will pay for the benefit he is going to get. So how can you identify what is the price the investor willing to, the buyer of the share at this point willing to pay? He is going to get this dividend. He is going to get this dividend in how many years? The person who is buying the share at the end of third year, he is going to get this dividend in another how many years? The person who is buying the share at this point, what is this for him? For him, what is this?
Year 1.
D1.
End of year 1.
Exactly. That is D1. So the person who is buying the share at this point, at the end of the third year, so this is the first dividend he is going to get. Right? For him, this is D1. And this is D2. This is D3. And this is P3 for him. Right? And we need to discount. Right? So we have to calculate P3. And how do you calculate P3? We need to discount. Right? So when you discount these values, we can calculate P3. Right? Okay. I will show this. Right now, the person who is going to buy the share, right? So he will pay this dividend, right? For this dividend, he will pay. You know, the dividend he is going to get. right? So we already know what are the amounts of these dividend. We already know, right? So we know the amounts of these dividend. So we need to discount. Right. So we know the person who is going to buy the share at this point. At this point, he's going to get these three dividend values. Sorry, these values. Right. So these are the dividend values. Dividend and right. So these are the dividends he is going to get, and he's going to get these dividend. Right. Then he's going to get this dividend in 1 year. Right. So as you mentioned, this dividend is going to get in 1 year. So what we have to do, that should be discounted, and that should be discounted for 1 year, because for him, the person who is buying the share, for him this is D1, right? This is D1 for him, right? Therefore, should be discounted for 1 year, right? So we have to discount this for 1 year. Right. So when you discount this for 1 year, right? What is the value? What is the value when you discount this for 1 year? Right. That means this 0.3346, we need to discount at 12% for 1 year. Right. 1 year. So here, in fact, the value for him will be this, and so he is going to get this dividend in 2 years. So it should be discounted for 2 years. Right. So we have to discount this for 2 years. When you discount this for 2 years, right, what is the value when it is discounted for 2 years?
293. 293.
Right, it is 0.2. Yeah, that's right. So here we can see it's 2934, and the next one he's going to get in 3 years time. So this is the dividend that he is going to get in 3 years, which should be discounted for 3 years. When you discount this for 3 years, what is the value? It is 2882. 2882, and this is the price he's going to get in 3 years, right? Because it was the price at the end of the 6th year, because when the person who is going to buy the share at the end of the 3rd year, so that is the price he's going to get in 3 years time. So therefore, that should be discounted for 3 years as well, right? That should be discounted for 3 years.
4.3226.
Yeah, it is 4.3226.
3 years, sir. Discount by 3 years.
Yeah, discount for 3 years, exactly. Yeah, that's right. So 3 years, so it is 4.3225. And when you add these 4 values, that is P3. That is P3, the person who is selling the share, right? So when we are selling the share at the end of the 3rd year, this is the value of P3. This is P3, right? So is that clear? The way we calculated P3, right? The price at any point is the present value of the future benefits. That is P3. Now we have P3. So P3 is 5.2029, and it should be discounted for how many years? It should be discounted for
3 years.
3 years, because that is the price at the end of the 3rd year. It should be discounted for 3 years. And when you discount that for 3 years, right? When you discount that for 3 years, what is the answer?
3.7033.
It is 3.7033. Right? And now when you add these 4 values, that is the share value today. What is the value? It is exactly the same amount you calculated earlier. See, did that have affect to the current value? The current value did not change. The current value did not change. The current price will change only if the estimates change, right? Only if the required rate of return change. But whether the holding of the share, when the holding of the share change, that will not affect to the value, right? So one, very good points you highlighted. Holding the share is up to the shareholders. Shareholders may change, but current value will not change based on the shareholder. So whoever holding the share will not affect to the share price. The share price will change only if the estimates change, only if the required rate of return change, right? So the fair value will not change based on the owner of the asset, but right, that will depends based on the future benefits, right? As long as the future benefits, right? Only the important thing, when you are going to sell the share at different points, if you are going to sell the share at the end of the third year, fourth year, fifth year, selling prices will be different. Selling prices will be different, but today's price will not be changed, right? Based on our expectation. So the seller, right? So we know the current price will not change based on our plan. Whether we are going to sell the share at the end of the third year, fourth year, fifth year, that will not affect to the current price of the share. The selling price will be different at different points, right? If we calculate P3, P4, P5, definitely it's different. Yeah. So P6 is this one, and P3 is this one, right? So definitely selling price will be different, but this price will not be changed based on our our plan of selling the share. So holding the share is our option. That's up to the shareholder. Shareholders may change, but that will not affect to the current price of the share. Okay, so to answer that question, so we check this, but you don't need to calculate these things to answer this question, right? So you can say the share price, the current value of the share will not change based on the point we are going to sell the share, as long as the estimates remain the same. Whoever the shareholder, today's price will be same. Okay, right. So actually, as I mentioned, usually in equity valuation, we don't get estimate for a low period like this. But when you practice this type of question, the exam question will be very simple. Right. So we did that calculation. Okay, there is one more point that we need to discuss with respect to this investment in shares. Right. So we know when we are going to invest in shares, we need to have some idea about the return that we can get, right? What is the return we can get from this share, right? So we need to know about the return. So calculate the return. To calculate the return that we can expect, we have different options. We have different methods, right? So how to calculate the return we can expect? So we call what is the expected return. What is the expected return? To calculate the expected return, we can use two main approaches. Right? We can use two main approaches to calculate the return. So that we can expect on average. That's why we call it expected return. Right? So we call it expected return. To calculate the expected return, we can use two main approaches. We can estimate the expected return based on historical information or based on estimated information, right? So we can calculate the expected return based on historical information or the estimated information. And if we use historical information, right, to calculate the expected return, so we have two main approaches. We can use the historical information or we can use the estimated forecasted information. right? Forecasted information. So if you use historical information, that's a fairly straightforward. If you use historical information, that's fairly straightforward. We have to get the actual return for number of years, right? For example, if you use the actual return for last several years, right? So we can use the actual return for last several years and then can calculate the average. So that's very straightforward. So if you want to know what is the return for stock I, what is the return for stock I over the last few years, right? Last several years, 2015, 2016, right? 2017. So few years we can use to get actual data, right? Suppose it was 15%, 10%, 8%, 5%, 14%, right? 18% like this. So we can use actual return, right? Actual return. And to calculate the expected return, what we have to do, we need to calculate the mean average, right? So very simple method. So what we need to do, we need to get the total, right? We have to get the total of these return, and that should be divided by
10.
number of observations. So that should be divided by number of observations, right? Number of values we use, n, right? So that's correct. So we call n. So here 6 periods are there. Okay, so we can get the total. We can get the total of this, that is sigma. It should be divided by the number of observations, right? So then you get the expected return. So the approach is very simple. This is the average, or we call mean return. So we have to get the total, and that should be divided by number of observations, n, right? So in mathematics, so you use the sign sigma of the return for this asset, sigma, and that should be divided by number of observations. So that is what we do. Very straightforward. And that's very straightforward, very easy to calculate the expected return using historical information. So on average, right, based on the information for the last 6 years, on average, we can get a return, right, from this asset closer to this. That is the meaning. That's meaning, right? And another approach, the other approach is to use estimated data. Estimated information, forecasted information. And if you use estimated information, that requires some analysis, right? So we need to estimate what are the possible return under different condition, right? So that means, so in mathematics you may have learned, right, probability distribution. So we need to do a sort of probability distribution. That means under different conditions. It may be different economic conditions, right? What are the possible, right, economic condition? And then what is the possible return, right, under different possible economic conditions? So here the economic condition, when we consider the possible, different economic condition, and what is the possible return? What is the possible return under that particular economic condition? What is the possible return? And then, for example, if the economic expansion is there, if there is economic expansion, what is the possible return, right? So we have estimated, so it's possible to get 50% return. Then what is the probability? What is the probability of getting that, of having economic expansion, right? What is the probability? What is the probability, right? So that means there is a 20% chance, right? There is a 60% chance, right? So like that, what is the probability? right? So if that is the probability of 30%, for example. In this way, we have to see what are the possible return and what are the probabilities of getting that return. There can be economic expansion, or there can be normal economic condition, or there can be economic decline, or economic recession, so like that, right? So economic so few economic conditions have, if we consider like this. So if the economic condition is normal, so it may be able to get around 13% return. If there is economic recession, return may be 2%. Like this, we need to, right? It's necessary to estimate the possible return under different economic condition for a particular organization. Then what is the probability of getting that return? So we have to consider all the probabilities, and always the total probability should be 100%. So we have to consider all the probabilities, right? Therefore, always the total probability should be 100%. Then what we have to do, each possible return should be multiplied by the probability of getting that return, right? So each possible return, suppose this is Ri, and if this is the probability of getting that return, so let's say Pi, and if that is the probability of getting that return, so then what we have to do, possible return should be multiplied by the probability of getting that return, right? The possible return should be multiplied by the probability of getting that return. And when you do this, we can, right? So that's easy. The possible return should be multiplied by the probability of getting that return. So here there is a possibility of getting 20% return if there is economic expansion. The probability of having economic expansion is 30%. So 30% of 20%, right? And there is a possibility of getting 30% return if the economic condition is normal, and the probability of having a normal economic condition is 50%. So 50% of 13%, it will be 6.5%, right? And so here also 20% chance is there, probability is there to get only 2% return. So 20% into 2%, right? So you get the possible return. And then when you get the total of this, right? When you get the total, this is the possible return, this is the probability of getting that return. So possible return and probability return, when you multiply, so you can get the total. So the total is the expected return. So expected return is 12.9%, like this, right? Is that clear? So we can calculate the expected return using the historical information or estimated information. The only thing, if you are going to use estimated information, that require number of analysis, that is to identify what are the possible returns, right? What are the possible returns under different possible conditions. Here only 3 conditions I have mentioned here, but in addition to this, there can be economic, right? As I mentioned, economic decline, economic slump, economic recovery, economic boom. So number of economic conditions are there. So number of different conditions can be considered here, right? So the thing, so whatever the number of possible conditions we consider, we have to consider. You have to use all the probabilities. Always total probability should be 100%. Right. So now in this way, we can estimate the return. We can get some idea what is the return we can expect when you invest in a particular asset. Right now, you know, this return is a very important point for us to make the investment decision. Right now, suppose you calculate the expected return for 2 assets. You calculate the expected return for 2 assets, A and B, right? Using either historical information or the estimated information, you calculate the expected return of 2 assets. The expected return for asset A is 10%. Asset B is 25%. What is the asset you prefer to invest? These are the expected return for 2 assets. Which asset do you prefer to invest your money? You calculate the expected return, A and B. Which one is better?
B.
B. right? So you prefer to invest in asset B, right? Others agree?
Depends on the risk, sir.
Yeah, because
Yeah,
you know that we can't make that decision just by looking at the return. Just by looking at the return, we can't decide what is the better asset to invest, better place to invest. You know, we can't decide just by looking at the return. So this may be the return, right? Then, for example, if these are deposit rates, this is the deposit rate of Sampath Bank. This is the deposit rate of Shakti. So you prefer to invest here, right? So we can't decide, right? We can't make that decision just by looking at the return. We need to identify, we need to consider another point, as you very correctly mentioned, because we know this return is directly related to what? This return is directly related to the risk. That return directly reflects the risk. Therefore, we need to analyze the risk also. We need to analyze the risk. When we analyze the risk, right? So when we analyze the risk, risk means what? This, how do you estimate risk? Risk means what? Risk means, right? So why we consider the investment in some companies or some financial assets very risky? Why is that? Risk means what?
You might lose your investment.
Yeah, so that means okay, ultimately you can lose your investment also, right? But normally when you you make investment to get a return also, right? And definitely you expect to get your investment back, right? And so you expect periodical return also, right? Because we discuss, you know, when we invest in financial asset, we expect periodical return, and definitely we need to get more than what we invested in terms of capital also, capital gain also we expect. But risk means what? Risk is the actual return. So we expect certain return, right? Normally, when we invest money, there is a return we always expect. But if the actual return is less than that, that is the risk. That means risk is what? Risk is the possibility the actual return different is less than what we expected. So if it is more, we don't worry, right? But the main thing, if the actual return is less, if the actual return is different to what we expected, so that is the risk. So risk is the possibility that the actual return change or deviate from the expected return. So risk is the volatility. Risk is the volatility. If the return of a particular asset is highly volatile, it's change. It's not easy to predict. That is the risk. Risk is the volatility. How do you measure volatility? How do you measure volatility? So in mathematics, you have done that. You have done that in mathematics. How do you calculate the possibility the actual return deviate from the expected return? What do you calculate? Sorry?
Standard deviation.
Standard deviation. You calculate the standard deviation, the possibility that the actual return deviate from the expected return. So there is a possibility that the return highly volatile, sometimes high risk, sometimes high return, sometimes low return. So that volatility is the, sorry, risk is the volatility, and which we can estimate using, right, as you mentioned, standard deviation. So we need to calculate the standard deviation. Right. So how do you calculate the standard deviation? So the risk we can measure using standard deviation. And also we can do using both historical information or estimated forecasted information. Right. So the risk also we can estimate using in the historical information or estimated information. If we use historical information, how do you calculate that? Right, the manual formula quite challenging. So if you see the standard deviation formula, right? So you might feel it's with difficult calculation, right? So this is what we did earlier. Possible return should be multiplied by each the probability should be multiplied by each possible return, and then we need to get the total. We need to get the total and expected return. So we can calculate using estimated data or using historical data, right? So when you calculate the expected return, so, using the estimated data, the probability should be multiplied by the possible return, and we need to get the total. So that's what we did here, right? Possible return we multiplied by possible return we multiplied by the probability, and then we get the total. Okay, and in order to calculate the risk is the possibility that the actual return deviate. So what we need to do, we calculate standard deviation. And how do you calculate the standard deviation? The possible return, right? So here, this is the possible return, and this is the expected return. You know, these are different letters are used in different books, right? So here for the expected return, this k hat is used here. The possible return minus expected return, we get the squared value. We get the squared value, that squared, right? That is to get the total deviation. Because when you deduct the expected return from the possible return, some values will be plus, some values will be minus. It will set off. Therefore, in order to see the total deviation, what we do, we calculate the squared value. Possible return minus expected return, squared value, that should be multiplied by the probability. You know, it's not difficult, right, as you see in the formula. Because now, so this is what we calculated. This is what we calculated. Right. First of all, I will show how to calculate using this estimated data. Now we calculated this is the expected return, but it's possible to get different return. So what we have to do, possible return minus expected return, right? So what we have to do, possible return minus expected return, Then, so to see the total deviation, we need to get the squared value of this. We have to get the squared value, right? That clear, right? Possible return minus expected return, and we get the squared value. That squared value, and then that the squared value we can multiply by the probability, right? That is the next step, right? So we can even do these all the steps in one cell. So that should be multiplied by the probability of getting that return. So this is what you have to do, right? So this is what you have to do, right? Okay, so that should be done for each variable, each possible return separately, right? So here, possible return is 20%, expected return is 12.9%. So what we need to do, right? Possible return minus expected return, and that should be, then we need to apply the squared value. So we need to get the squared value, and that should be multiplied by the probability of getting that return. So what is the probability? 30%. So we get this one. So this should be done for all the possible return. For all the possible return, we need to do this. Right. So here, this expected return is saved. The expected return is same. Then, so when you apply this, we get these values. And when you get the total, for this one, that is the, right? So that is this part, right? So here, possible return minus expected return squared value into probability, get the total, sigma, this part. But standard deviation means the square root of this, right? It is the square root. So how do you calculate the square root of this? We have a number of methods. Either this should be to the power 0.5, that is the square root. So this is the standard deviation. This is the standard deviation of this asset, and that is one method. And otherwise, when you calculate this, that square root sign is there, right? So when you calculate this, you can so in your calculator, when you use any scientific calculator, right, in your calculator, so here to calculate this square root, so when you use this one, because this is the variance now, this is the variance, so that is the total of these values, that is the variance. The square root means the right standard deviation means the square root of that, right? So here with Excel, this is what you can do. Otherwise, in calculator, this root sign is there. Here the root sign is there as the second key. So what you have to do, if you want to calculate the square root, you need to put 2 first, then shift and this sign, and those who have 200V, I think the function is little different. There the square root function sign is directly there, right? I think at as a second key in one some other main key, not here. And those who have 200 FC 200V, the function is a little different. But here 100V, so you have this root sign separately, right? So like this, right? So then using that also you can calculate. Otherwise, as I calculated here, so what you need to do, you can put this way, 0 point, right? So to calculate the standard deviation, 0.03889 to the power 0.5. If you calculate this way, then also you get the standard deviation. Otherwise, what you have to do, so you have to put 2 and then shift, right? Then shift, right? So the steps to follow using the financial calculator. When you have 100V calculator, you have to put 2, then shift, then that particular key, right? What is that key? It is this key, right? That hat key you have to use this one, and after that you need to insert the value 0.0038889, and then so you can when you press exe, you get the answer. Just check the 2 methods, so you will get, you can calculate the standard deviation.
Sanju, just a quick question on cell number M35. Why does it say 5E-07?
Okay,
That
that's a very small number. That's a very small number. So many decimal points are there. So if you put this way, that's a very small number. Here, that the first so here when you get here, the first number is the third decimal point. That is the meaning. Is 5 is the third decimal point. So if you write it in a decimal point here, the first number is the third decimal point. 1, 2, 3, 4, 5, 6, 7. So when there is a very small number, so that is how the even if you calculate, if you do this calculation using your normal calculator, scientific calculator, so it will give the answer that way, because it's a very small number. This first number 0.5
is the 7th decimal point, right?
7th decimal point. First number is the 7th decimal point. Right. So when you calculate this way, did you get the answer? 6.24%. This
Yes.
method or this method, right? So you can get the standard deviation. right? So you got the answer, right?
Yes.
Right.
Yes, sir.
Actually, when there are yeah. Any question?
Yes, sir. Okay.
Right. Okay. So we can calculate the standard deviation that way. If you use historical data, the formula is little different. The standard deviation using historical data. So here, possible, the historical data means actual return minus expected return. Then no probabilities. No, historical data means no probabilities, right? Therefore, each return minus expected return squared value, we get the total, and that should be divided by n minus 1. N minus 1. So here, that formula, okay, I think right. So you may have received this note. This may be uploaded to the system. There, when we calculate the expected return, this is that the formulas little bit difficult to put in that Excel sheet. So that's why here that difficulty is there. The expected return. So this is how we calculated the expected return, right? What is the formula we use here? This is the formula we use, right? The expected return. This is the formula we use. The expected return. Each return we multiply by the probability of getting that return. So this is what we did. And this is what we did. Each return we multiplied by the probability of getting that return, and we got the total. That is how we calculate the expected return, right? Using using estimated data. And if we use historical data, we simply get the total and divide by number of observations, right? We divide by number of observation. And when you are going to calculate the risk, so this is what we did using the estimated data. Using the estimated data, this is what we did. Right? So this is what we did. Each return, possible return minus expected return, we got the squared value, then we multiply by the probability. We got the total, then calculate the square root, right? Each return minus expected return, right? Minus expected return, so that's what we did. And then a squared value, that multiplied by the probability, and we get the total. We get the total, then when we get this total, we calculate the square root. That is what we did. Right? This is using estimated data. If we use historical data, this is the formula. This is the formula when we use historical data. When we use historical data, this is what we do. This is what we do. Each return minus expected return squared value, then we get the total. It should be divided by n minus 1. N minus 1. Right? So here each return. So now we got this information. We got these values for this particular product. When we get these values, right? Now what we have to do? Each return minus expected return, and then squared value, right? Each return minus expected return, then the squared value, right? Squared value. And since this is constant, right? So now when we do this, we get these values, and then we need to get the total. we need to get the total. The total is this, and then should be divided by n minus 1. So this should be divided by n minus 1. N is 6, minus 1, 5. So this is the standard deviation. No, that is sorry. That is that we divide by n minus 1, then that is this part. So we have to calculate the square root of this. We need to calculate the square root of this. This is to the power 0.5. Oh, right. We can use that calculator. So we got this. Right. Actually, when we have this information, these values with Excel, this is fairly easy, right? Here we use the formula, but if we use Excel, the calculation of expected return and standard deviation using Excel is so straightforward with the historical data. So here, as I mentioned, this is the average. This is the average. So here, it's better of putting average and selecting the data. You will get this expected return. See, you get the expected return. That's straightforward. And similarly, the standard deviation, so you can get here, standard deviation is there. So it's a matter of selecting the data set, right? Standard deviation. So here you will get the answer in 1 second. With Excel, that's so easy when we use historical data, right? But this is using the formula. You can see the formula that's that can be used. But because in the exam, since you don't get the opportunity to use Excel, right? Otherwise, using Excel, the calculations very easy to calculate expected return and standard deviation. But expected return and standard deviation you can calculate using the financial calculator, right? Using the financial calculator, we can calculate the expected return and standard deviation, right? Because we saw some calculations in this study text with respect to the expected return and standard deviation. So we can do that using the financial calculator also, right? So we'll discuss this. Here actually there are a couple of steps to prepare the calculator to do this calculation. After that, to calculate this expected return and standard deviation, that's very straightforward. We need to insert data and get the results. But initially, to clear memory and to select the stat mode, to on the stat mode and to select the relevant type, so there are a couple of steps. And after that, we can insert data and get the results. Okay, so we'll discuss the steps to calculate the expected return and standard deviation using your financial calculator also, right? I think it's better to take a break now. So we'll take a break, and after that, we'll discuss how to do this calculation using financial calculator. Up to now, the points we discussed, is that clear?
So on the last calculation, the risk percentage is 4.87, isn't it?
Yeah. So here, okay, now this standard deviation is 4.84%, and here we got the standard deviation 6.24%. Right? What is the meaning of this? What is the meaning? Now, here, even though the expected return is 11.67%, the standard deviation is 4.84. That means sometimes this expected return can, actual return may be 4.84% more than what we expected. Sometimes it is less than 4.84% less than what we expect. Average, generally this is the standard deviation, right? So it can increase or decrease, right? That's why here when you see this return data over the last 6 years, right? So average return is this, but sometimes it can increase, sometimes it can decrease. And the standard deviation, standard deviation, higher the standard deviation is better or lower the standard deviation is better?
Lower is better.
Sorry?
Lower.
Lower.
Lower standard.
Lower the standard deviation is better. Lower the standard deviation is better, because if the standard deviation is very, very high, sometimes you may get very high return, sometimes you get very low return, right? That's why highly volatile, highly volatile. But normally, there are some investment instruments in the market which are considered as risk-free, right? Normally, right? So we have discussed, when we discuss the valuation of financial assets, what is the investment security that we consider as risk-free usually?
Bond.
Treasury bill, right? Treasury bill. Why we consider as risk-free? Because return is not volatile. So when you invest in a treasury bill, expecting a certain return, definitely you will get that. You pay the price today, expecting to get the face value at the majority, definitely you will get that. That means return is not volatile. You see, it is not volatile. But why we call investment in shares is more risky? Highly volatile. Sometimes you may get high return, sometimes you get very low return. Okay, so that's why this standard deviation indicate the possibility that the actual return deviates from the expected return. Right? So lower the standard deviation is better. If the standard deviation is low, that indicates the return is less volatile. Okay. Any other question?
But if you have a high standard deviation, can
Yeah.
you necessarily say a bad thing? Doesn't it depend on your appetite for risk?
Exactly.
have-
You know, standard deviation is high does not mean all the investors will not select that asset. You know, if definitely if you want to get a higher return, definitely you have to take risk. And as you very correctly mentioned, all the investors will not select the investment assets with securities with very low standard deviation. That the selection of the asset depends on the level of risk investor willing to take, and the correct word you use, the risk appetite, risk tolerance. And therefore, it's not this is not a rule. This is not a fact that everyone will follow equally, right? So definitely, if you want, that's why I mentioned the treasury bill considered as risk-free, but you can get only very low return. So if you want to get a relatively high return, definitely you need to You need to accept some risk. You should be willing to take some risk, right? Otherwise, right, the total. So if a particular person invests his total capital in treasury bill, only very low return can be obtained. But if you want to take, get high return, definitely you have to take risk, right? So you have to take risk. So that's why sometimes you may get high return, sometimes you may get low return, but so you need to accept risk if you want to get higher return. The selection entirely depends on the selection of assets for investment entirely depends on the level of risk investor will need to take, and the correct word you use, risk appetite, risk tolerance. Some investors are highly risk averse, some investors are less risk averse. The willingness to take risk is the major factor that the investors will select different assets based on the willingness to take risk.
So excuse me.
Yeah.
So my question is not here. It is a previous lesson. So in constant growth rate model. So can you go to that equation?
Constant growth rate.
Yeah.
Okay.
So this this one D0 1 plus G minus R minus T. This equation, sir. If it is growth rate higher than required rate, is it mean this equation doesn't work? No.
Yeah. So, that means if the growth rate is more than or equal to the required rate of return, we don't get any realistic answer. This model cannot be applied, right? In fact, we did some calculation related to that, right? So here, if the growth rate is equal to the required rate of return, or if the growth rate is more than the required rate of return, we don't get realistic answers, right? Why? Because and we also discuss, right? And we know if the growth rate is equal to more than the required rate of return, is it realistic? Is it logical to make assumption like that? Assume a growth rate more than the required rate of return. It's not logical, right? Why? We discussed the required rate of return is a combination of things. Right? So when we are going to invest in shares for a particular asset, we require certain return, right? So when you are, especially when we are going to invest in equity, we require, right? We expect two types of return: dividend yield and capital gain. So capital gain is possible only if there is a growth. So growth is only one part of the required rate of return. So one part of the required rate of return, right? Growth is only one part of the required rate of return. So growth cannot be more than the required rate of return. If someone is assuming a growth rate more than the required rate of return, that's not logical. So if there is a fairly high growth rate, we also expect dividend also, right? Therefore, definitely the required rate of return should be even more than that growth rate, right? So it is not logical to assume a constant growth rate which is more than the required rate of return. So as you very correctly mentioned, if the growth rate is more than the required rate of return, this model cannot be applied.
Yeah, okay. Thank you, sir.
Right here, this model, this constant growth model, this model can only be used where the investors' required rate of return exceeds the dividend growth rate. If the dividend growth rate is more than the required rate of return, this model cannot be applied. Right? So what you mentioned is perfectly correct.
Okay, so thank you.
Right. Okay, then any other question? Okay, then let's take a break. And after that, we'll discuss how to calculate this expected return and standard deviation using the financial calculator. And we'll do
So
some.
one
Yeah.
small question. Can
Yeah.
you show me the formula for column cell D48 for the historical information, how we calculate the risk?
Right. Okay. Here actually this is the square root of this, because here we when you using the historical data, each return minus expected return. Right now is 15% minus 11.67 and squared value. Right. So here possible the actual return minus expected return squared value. This one, right? For each one, for each return, we did that calculation. 15 minus 11.67, then square. And then we need to get the total, sigma. We need to get the total. So that is what we did here. We did the value for this part. Then that should be divided by n minus 1. So this should be divided by n minus 1. Now this is the answer for this part. Then we calculate the square root of this. Right? So here, this is the square root of this to the power 0.5. To the power 0.5. I think in Excel you have square root also. Yeah, here square root. Square root of this. Yeah. Then also you get this. Right? With Excel, this calculation is quite easy. This is using to the power 0.5. This is using square root that inbuilt function.
Thank you, sir.
Right. Right. Okay. So then, so let's take the break. After the break, we'll do some calculation related to this expected return and standard deviation. Okay, so this is the manual method of calculating expected return and standard deviation. Like this expected return and standard deviation calculations important for this module, because there are a number of topics that we need to calculate the expected return and standard deviation, right? And so with the financial calculator, it's very simple, but initially, so we need to be familiar with these steps, right? I will I will highlight the points here that we need to follow in order to calculate the expected return and standard deviation. In fact, as I mentioned earlier, these first few steps just to clear the memory and to select the relevant type, right? After that, so it's matter of inserting data and getting results. The first step, to clear memory. Clear memory. Clear memory. So you have to use shift, then 9, then you need to select all. So here in the calculator, so you since clear is given as a second key, so here you can see, right, it's given as a second key in 9. So you have to press shift 9, and after that, when you press shift and 9, what do you get? So here you get the screen with when you press shift and 9, so you get this screen, and then you need to select all. You need to select all. So using this big black button, you can go down. So you have to select all, right? So then shift 9. So you need to select all, and then put press exe, right? Exe. You have to press exe twice. Exe. Right. So this is the first step. This is the first step, right? So you have to press shift, then 9. Then when you get this, you select all, then press exe, again exe. Then you get this way. It says reset all. So now the memory is clear. Is that okay? So did you clear the memory? So you got reset all.
After we press exe twice, do we have to press the all clear button again? And then
No. Initially, you have to select all, right? So that means shift 9. So you get this one. So when you press shift and 9, you get this one. So then you select all, press exe twice. That's all. Exe. Then you get this one.
the last screen there says press AC key. Do we have to do that?
No. Oh, yeah. So that means in order to do some other calculation, so you have to press AC. That means to clear the screen, you have to press AC. Right? Okay, that is right how you clear the memory. Then the next step is to on the stat mode. On the stat mode. On the stat mode, right? So what you need to do now you have this screen. So in order to on the stat mode, you have to use this setup button. Just next to the on button, you can see setup. You have to press setup, right? Setup. And when you press setup button, you get this one. Then you need to go down until you find stat. You need to go down. Then it shows stat off. Right? You can see stat off. It says stat off. Right? Then you need to, right? So you have to press EXE and then select on. You have to press EXE, then select on. Select on and press EXE. Okay, now you on the stat mode. The stat mode. The next step is to select type. To select type, right? So next step is to select type. So that means now after you on the stat mode, now you have the screen this way, stat mode. Then what you have to do, there is stat button here, just below the solve button, just below the solve button, you can see stat button. So you have to press stat, right? You have to press stat. Then when you press stat, you get this screen, one variable. So you get one variable. So you have to press exe, right? One variable. So yeah, right, when it highlight one variable, you need to press exe. Then you get these two columns, right? You get these two columns, x and frequency, right? So when you select type, right, you get these two columns. Now it is matter of inserting data. So now insert data. Insert data. When you are going to insert data, so you know, because you have two columns. You have x and frequency. You have x and frequency. So you have two columns. X means the return. X means the return, and frequency is the probability. X is the return. Frequency is the probability. Right? So under X column, next column you have to insert return. Under frequency column, you need to press, you have to insert probability. Right now, if we use this example, I already used, right? One second, Nipunika is calling. Okay, so then you know, there is the example that I already used. We can do, right, using this financial calculator. X means the return. Now return data. So I have put here return data. I have put here 20%, 13%, 2%. Right. So you can put these values 20, right? 20 exe. When you insert any data, you have to press exe. 20, 13, 20 exe, 13 exe, and 2 exe. So now, right, did you insert return data? X means return. 20, 13, 2. Okay. Is that okay? Did you insert the return data?
Yes.
Now when you insert return, now using this big black button, you go to the next column and go up. Then in front of 20, you have to press these probabilities, right? 30, 50, and 20. 30, 50, and 20, right? So you can insert the data. Now, did you insert all data, x and frequency, return and probability?
Yes, sir.
Right.
Yes, sir.
Okay. once you insert data, right? So now you have inserted all the data. Then the next step is to view the results. So we can get the results. Get results. In order to get results, so this is the step we need to follow to get the results. We have to press AC first, right? AC, then shift, stat, and 5. We have to press shift, stat, and 5. Right. So when you insert data, now when you insert data, you have this screen. You have this screen. So then you have to press AC. You have to press AC. Then you get this clear screen. So press AC. Then shift, stat. When you press shift, stat, you get this screen and press 5. Press 5. When you press shift, stat, 5, you get this screen. Right? Did you get this one? Did you get this one?
Yes.
Yeah.
Yes, sir.
Right.
Yes.
Now when you press 2, when you press 2 and exe, when you press 2 and exe, you get expected return. When you press 3 and exe, you get standard deviation. Okay, so when you press 2 and exe, right? So when you get this one, when you press 2 and exe, you get the expected return. What is the expected return? 12 point, right? What is the expected return?
12.9.
Yeah, 12.9. Right here, that is the expected return. Then in order to, in order to get the results, we have to follow these steps. Right? Once you get this expected return, now press AC again. Press AC again to get the standard deviation. Follow the same step. Shift, stat 5. When you press shift, stat 5, you get the same screen again. When you press 3 and exe, you get the standard deviation. What is the standard deviation? 6 point. You get 6 point. 6 point. What is the answer you got? 6 point.
24.
Yeah, you get 6.236. That is 6.24%. Okay, that clear? Now to be familiar with these steps, you do the calculation for the example given in this study text. So here there is a example. There is a calculation in page number 20. Page number 20. This probability of occurrence and the possible return given. So calculate this one. So this is in page number 20. So use your study text and using these steps, right? Calculate the expected return and standard deviation. So these are the steps to be followed. Right, calculate. And if you have any doubt, so please tell me. So calculate that.
So can you share the question, sir? Thank you, sir. Okay.
Okay.
8.38 standard deviation. Square root of 9%. Okay.
Right. Okay. Did you right get the answer? What is the expected return? What is the expected return?
Expected return 9%, sir.
Yeah, expected return 9%, and the standard deviation
Standard deviation 8.38.
8.38. Right. So you all got the answer. Anyone who has any issues in calculating? These steps, everyone clear? Right. You all got the answer. Answer correctly.
Yes, sir. I got it.
Right. Okay. Then that's great. Right. So that means
So can you repeat the answers again?
so you mean the steps, so?
Those are the sum that we tried. Can you repeat the answers again? The variance and the standard deviation? Sorry, the expected return and the standard deviation?
This one.
Yes.
Yeah. So here so you need to insert these return data. So that means you have to clear the memory first. So did you clear the memory?
Yes, sir.
Right. And so that is shift 9, you select all exe. Then you need to, right, so then you need to, on the stat mode, that is you go to setup, you go down until you find stat. When you find stat, so it highlights stat off, you press exe, and then you select again exe. Then you need to select the type. So that means you go to the you have to press stat and select one variable. You get these two columns. Then you have to insert return data. So here return data, return data, you can insert as decimal point or as full figures. Right. So here, so since it is given a decimal point, so you can insert that way. Otherwise, you can even put insert as a total figures. Right. But here the possible, we have to insert in the correct column. So here X means return. So whatever the order of giving information, X means return. In the return column, you have to insert this X column. You have to insert this return, right? So minus 0.1. Here minus 0.1. Then minus 0.02, minus 0.02, 0.04, 0.04. Then 0.09. 0.14, 0.2, 0.28, right? So you have to insert all the return data. When you insert all the return data, then you need to use this big black button to go to the next column and go up. So in front of the relevant return data, in front of this first return data, that is minus 10, you have to insert the probability. 0.05, right? So in front of the relevant return, you have to put the probability. In front of minus 10%, you have to insert 0.05. Then 0.1, right? 0.1, 0.2, 0.3, 0.2, 0.1, 0.05. Right? So you have to insert all the probabilities. Now we inserted all the return and all the probabilities, right? Then we have to, right? So which means we insert data. We insert data. Now we need to get the results. To get the results, when you insert data, you need to press AC. You need to press AC. Then shift stat 5. When you press shift stat 5, you get this screen. Then you have to press 2 to get the expected return. When you press 2 and exe, you get the expected return. What is the expected return? 0.09. That is 9%, right? 0.09. Then in order to get the standard deviation, again you have to press AC, then shift stat 5. Shift stat 5, you get the same screen. To get the standard deviation, you need to press 3, right? You need to press 3 and then exe. Press exe. You get the standard deviation, that is 0.0838. That means 8.38%.
Thank you, sir.
8.38%. Yeah. Okay. Is that okay?
Yes, sir. Thank you, sir.
Right.
Just a quick question. What does the fourth option mean there? Now, for variance, we press number 3.
Okay. So that's a good point. That means because we can calculate this expected return and standard deviation for using both historical data and estimated data. So if we use historical data, okay, that's good to us. That if you use historical data, we have to press 4 to get the standard deviation, right? So when you press shift stat 5, as you mentioned, we get this screen. 1 means one include n. N means number of observations, right? 2 is the expected return. 3 is the standard deviation. 3 is the standard deviation when we use probabilities, estimated data. So this is when we use estimated data, right? And in order to get the standard deviation when we use historical data, we have to press 4. Right? If we use historical data, we have to press 4.
But when we use historical data, we won't put in a probability, will we?
Exactly. Okay, that's the other important point. So that means when you are going to insert data, then if you use historical data, there are no probabilities. That means this frequency column you don't need to fill. So when you insert return, automatically frequency column include 1. So that means, as you very correctly mentioned, if you use historical data, no probabilities, right? So that also will calculate now in this study text. We'll do an example that has that include historical data. Okay, this one. This is in page number 24. Page number 24, question number 4. That include historical data. Historical data. Page number 24, question number 4. Right. So let's do that.
So can you share this thing, sir? Question.
Okay. right? So here in this question, you can see historical data given with respect to two assets, historical data given, and so the information available for the last several years, right? So calculate the average rate of return for each stock, right? For these two stocks, you have to calculate the average return, right? And assume that someone held a portfolio consisting 50% of stock A, 50% of stock B. What would have been the realized rate of return on portfolio in each year from 87 through 91? What would have been the average return portfolio, right? And calculate the standard deviation for each stock and for the portfolio, right? So here, detail given for two products, right? For the let's say 5 years, information given, right? If I just use the information here, right? So these return data are given, right? And right. So then, so you can easily calculate for these two stocks, right? A and B, and in addition to that, there is the portfolio also, which include 50% of A and 50% of B. So if you have 50% of A and 50% of B, then, right, so what do you need to do? 50% of this one plus 50% of this one. Right. Okay, these are the data for these 5 years historical data available. Now we have to calculate the expected return, standard deviation, expected return and standard deviation, right? For these two stocks and for the portfolio, right? Right. So we know the calculation of expected return is simple. Right now, using financial calculator, let's do this. Right. Shift 9. You select all exe just to familiar. Right. So you clear memory, and after that we have to on the stat mode, that is setup. We select stat. Then we on the stat mode and exe. Then we select the type stat. Yes, you get these two. But now, as you mentioned earlier, no probabilities. These are real, actual data. So then, to calculate the expected return and standard deviation for A, so what we need to do, we have to insert this data. Minus 18, right? Minus 18, 33, 15, minus 0.5, 27. You can see when you insert this data under the frequency, you can see one is given. So that means these are historical data. You don't need to put any probabilities. These are actual data. Then it is right necessary to insert only the return data when you use historical data. Right now, to get the results, we know we press AC, shift stat 5, shift stat 5. When you press 2, you get the expected return. What is the expected return?
Expected returns are 10.4%.
11.3.
10.4% A, standard deviation 21.51.
Is that the answer you got, others also?
11.3.
11.3, right? So we get 11.3% as the expected return. Expected return is 11.3, right? So just check the values, right? Whether we have inserted the values properly. The expected return we get 11.3%. Then we press AC again, shift stat 5. Now to get the standard deviation, what is the number you have to press now?
4.
4, right? We have to press 4 and EXE. 4 and EXE. What is the standard deviation? What is the standard deviation?
20.78.
20.789. So that means 20.79.
Yeah.
Right? So we get
Answers are other portfolio B. So first I told you.
okay. Portfolio B. Now to calculate for the portfolio B, now we don't need to follow all the steps again, because when you are going to calculate for two assets, we don't need to do this for we don't need to follow all the steps. Now we have to change only return date and have to change only return data. What you can do, you press stat button, then you get this one, right? Press EXE. You go to the data table, right? To go to the data table, that's what you need to do. Stat, press EXE. You go to the data table. You need to replace only data, right? You just insert this data, right? Minus 14.5, minus 14.5, then plus 28.8, so 21.8. 30.5 minus 7.6, 26.3, then AC, shift stat 5. When you press 2, you get the expected return. What is the expected return for stock B?
10.4.
Stock B, what is the expected return?
10.4, no?
I got 11.3.
11.3.
Yeah, so we get 11.3. And then to get the standard deviation, AC, shift stat 5. When you press 4, you get the standard deviation. What is the standard deviation? 20.777.
77.
So that means 20.78. The same calculation you can do for the portfolio also. You go to you need to change only data table, the data, right? You go to stat and press EXE. You go to the data table. Just replace the data. Minus 16.25, right? Minus 16.25, 27.4, 22.75, minus 4.05, and 26.65, right? Then AC, shift stat 5. When you press 2, you get the expected return. What is the expected return? Expected return is 11 point. The expected return is 11.3, right? And what is the standard deviation? What is the standard deviation? AC shift, right? AC shift stat 5. When you press 4, you get the standard deviation. What is the standard deviation?
20.12.
20.12, right? 20.128. So we get 20.13, right? Okay. So that's easy, right? It's easy to calculate. When we use historical data, as so one of you asked earlier, you don't need, right? We don't need to insert return data. So we don't need to insert the frequency, that is probability. So we can okay. So then we get this values. So you calculate the average return for the two stocks. You calculate the average return for the portfolio, and you calculate the standard deviation for the two stocks and for the portfolio. Right now, okay. Another point that we didn't discuss earlier. when we have, right, so when we have two assets, for example, suppose there are two assets, x and y, so if you calculate the expected return and standard deviation, right, suppose there are two stocks with this return and risk information, right? If there are two stocks like this, which asset do you prefer? Right?
X,
Normally, rational investor will select which asset?
it is X.
X, right? So definitely X is better. X is better, right? Why?
Why standard deviation is low?
Lower, right? While the expected return is same, standard deviation is low, right? So definitely any rational investor should select stock X, right? And if there are two stocks like this, P and Q, suppose these are the return data. There are two stocks with this risk and return. Which one is better?
Q is better.
Q is better. Q is better, right? Why? Same
Because
standard deviation. If the standard deviation is same, we have to identify the asset with the
return is high.
Return is higher, right? So if the risk is same, so higher return asset is better. And if there are two assets like this, which one is better? Which one is better? If there are two assets like this, which one is better? That we can't directly say A is better or B is better. Why? The asset with relatively higher return also has higher risk. In that case, we can calculate another value to see what is the better asset for the risk we take. For the risk we take, what is the better asset? That is called coefficient of variation. We can calculate a value, right? We can calculate a value known as coefficient of variation, right? Coefficient of variation. So coefficient of variation we calculate to identify the risk per unit of return. To calculate the risk per unit of return, we calculate, right? We can calculate coefficient of variation, right? Coefficient of variation. So coefficient of variation equal standard deviation divided by the expected return, right? So coefficient of variation equal standard deviation divided by expected return. So it measures the risk per unit of return. Risk per unit of return. Risk per unit of return. So the coefficient of variation measures the risk per unit of return. For the risk we take, what is the return we can expect? Right? Risk per unit of return. To earn 1% return, what is the risk we have to take? That's why we call risk per unit of return. So coefficient of variation. Okay, now if you calculate the coefficient of variation for these options. So asset A, B, and for the portfolio. Coefficient of variation. We calculate standard deviation divided by expected return. Right. What is the coefficient of variation for asset A? 20.79 divided by 11.3. Coefficient of variation. So it measures the risk that we have to take to earn 1 unit of return. What is the coefficient of variation for stock A? 1 point?
4.
1 point? Oh, sorry. That's 1.8.
4.
Right? So it is 1.84. So coefficient of variation is 1.84. And what about for stock B? Almost the same thing, right? 20.78 divided by 11.3.
Yeah.
It's the same thing. And for the portfolio, 20.13 divided by 11.3.
$1.78.
1.78. Right? So when you calculate the coefficient of variation, what is the better condition for the investor? So coefficient of variation, higher the coefficient of variation is better or lower the coefficient of variation is better?
Low is better.
Lower the coefficient of variation is better, right? Lower the coefficient of variation is better, right? Right, because in this study text, this coefficient of variation, so we can see the formula is given in the other way. This is not correct, right? The coefficient of variation measures the risk per unit of return. That means the formula is standard deviation divided by expected return. It is not expected return divided by coefficient of variation, right? Right. So, but the answer is correct. The answer is correct, but here the formula they have given in the wrong way. So it is not expected return divided by standard deviation. It is standard deviation divided by expected returns. Here, if you divide 30% by 10%, you should get. Here, the answer is correct. Right. Answer is correct, but formula so they have given in the wrong way. So right, that's you can just change this. This side expected return should come here, standard deviation should go up, right? Then so here lower the coefficient of variation is better, right? If the coefficient of variation is low, the asset is less risky. You have to take a relatively low risk. So right, this coefficient of variation is important when the risk and return data are different, right? Risk and return values different. Because here, if the risk and return data for two assets, when you are comparing, if the risk and return data like this, we can, at a glance, we can identify what is the better asset, right? If the return is same, we have to select the asset with the low risk. If the risk is same, we need to select the asset with higher expected return, right? Then, but if the risk and return both different, then we need to calculate the coefficient of variation, right? So coefficient of variation, that is standard deviation divided by the expected return. Then we can see which one is which one is better, right? So which asset is better. Right. So when you compare these two assets, what is the better asset in terms of the return we can expect for the risk we take? What is the better asset? What is the better asset? Asset A is better, but right again the point one of you mentioned earlier. So this coefficient of variation is lower means we have to face relatively low risk to expect a certain level of return. But that doesn't mean, right? That doesn't mean all the investors will select this one. So if you select this asset, this is the return we can expect. But even if you have to face relatively higher risk, you can expect much higher return. So if you select this asset, therefore, those investors who are willing to take risk, some additional risk, in order to get relatively higher return, they may select this one. Therefore, this coefficient of variation useful for us to identify what is the asset? What is the asset that will generate relatively higher return for the risk we take, right? So in other words, what is the risk we have to take to earn a certain level of return, right? So this coefficient of variation provide us useful information, but that doesn't mean all the investors will select that one, right? So when we consider this investment decision, the investment decision purely based on the risk appetite. Some investors are highly risk averse, some investors are less risk averse. Because there are some investors, those who are seeking for risk seekers are there. We call risk lovers there. But at the same time, there are highly risk averse investors. Therefore, the investment decision depends on the level of risk the investor is willing to take.
Sanjeev, just a quick question.
Yeah.
When looking at X and Y, as you said, I mean, the expected return on both is 10%, but
Yeah.
the volatility is more on Y.
Yeah.
Does that also mean that on the upside, that your 10% return can go up to 18%?
Yeah, that's a possibility. Yeah, definitely. When the expected return is same, so standard deviation is higher, mean there are some there is a possibility to get a even higher return.
So if I were a risk taker, I would potentially consider that as well then.
Exactly. Now that's a very valid point. This is related to that probability distribution. And I think I have not included here. So when you take that probability distribution, so the point you mentioned is perfectly correct. That means while the expected return is same, if the standard deviation is high, that indicate in certain period, there are some possible probabilities where you can expect, you can get very high return, sometimes very low return. So standard deviation is higher, mean both results possible, sometimes very high return, sometimes very low return. So that's why, so in that case, that's why I mentioned logical investor will select this one, but those who are willing to take risk, so may select this one, right? So because this is average expected return, but as you very correctly mentioned, there is a possibility to get a higher return than this one, than asset X when you invest in asset Y. Because
also, just one other question. You mentioned that the formula is incorrect on the book, on the study guide. Which page is that on?
This is in page number 21. Page number 21. These two values should be changed.
It should be upside down, right? Standard
yeah,
deviation.
yeah. Standard deviation should be in the numerator. So it should be in the numerator. Standard deviation divided by expected return. It is
Thank
not
you.
expected. Yeah. So the investment decision purely depends on the risk investor willing to take, right? So even that's why logically this asset is better, but definitely standard deviation is higher, means. So the point you mentioned is correct. That means when we use that bell curve, so that probability distribution. So in mathematics we have learned that bell curve, right? Probability distribution. When we use this bell curve, right? This higher standard deviation means it looks like this, but low standard deviation means the possibility for deviation is less, right? So that's why so when it's like this. It's like this. So here the probability of deviation is low with respect to this blue curve, but this orange one higher deviation is possible. So that's why sometimes you may get very high return, sometimes very low return. But here the deviation is relatively low. So that's why you can expect relatively stable return. So but final decision related to the investment depends on the level of risk investor willing to take. So in fact, this part form the basis for the next topic, right? So here when we discuss this expected return and standard deviation, right, for the individual assets, then normally rational investors, right, what they do, they don't invest the total capital they have in one asset, right? Why is that?
They give for portfolio.
Better to create a portfolio. So normally it's better to invest in a portfolio. Portfolio means, right, so you invest in number of companies or number of different assets. So that's the next topic. So therefore this expected return and standard deviation, the concept included at the end of this chapter. So that is the basis to this, right, move to the next topic, the risk, return and portfolio. So throughout this topic also, that the point, right, that is the investment decision purely based on the risk they are willing to take. Right? Therefore, this the correct understanding, right? The good understanding about this risk and return. So when we analyze either historical data or using estimated data, so we should be able to get some understanding about the risk and return of the assets that we are going to consider invest. To identify the best asset or the best combination of assets to invest. Right. Okay. Any questions? Any further questions?
So on the last example,
Yeah.
The coefficient variance is 1.78 on the portfolio.
Yes.
So basically for 1% return, your risk is 1.78% or its times.
Yeah, actually this can be interpreted both ways, as you mentioned, right? To earn 1% return, 1% return, you have to take risk of 1.78%. Otherwise, for 1 unit of return, so you have 1.78 units of risk. Right? So this okay. Then when we consider this this information, in fact, that last point we didn't discuss also. When we have option like this, we calculate the coefficient of variation. If you are a risk averse investor, would you prefer to hold stock A, stock B, or the portfolio? Right? If you are a risk averse investor, you prefer to invest in stock A, invest in stock B, or the portfolio?
Portfolio.
Right? Lower the standard, lower the coefficient of variation is better. Right? So here, normally, if you are going to create a portfolio, and so here we can see there is a certain level of risk reduction. But when you observe the return pattern of these two assets, if you are going to create a portfolio, these assets are these really good assets to create a portfolio? When you are going to create a portfolio, it's better to select very similar assets or different assets.
Different assets.
Different assets. But here, when you observe these two assets, right, the return pattern is very similar. When the return is negative here, it is also negative. When the return is very high in this asset, it is also high. Very high return here, very high return. So when the return is negative, return. Right? These are not very good assets to create a portfolio. Because, right? There is no real benefit of creating a portfolio if we select assets like this, right? But we know it's not perfectly similar. That's why even if we randomly select assets, there will be certain level of risk reduction. See what has happened to the standard deviation. These two assets are very similar assets. The return pattern is very similar, right? Very, very close. But even if the two returns are very close, closely related, but still there is certain level of risk reduction. That's why it's always better to create a portfolio. But to get the benefit, real benefit of creating a portfolio, right, as you correctly mentioned, we need to select assets with different return pattern. Because what is the main objective of creating a portfolio? What is the objective of creating a portfolio? To get the benefits of diversification. To get the benefits of diversification. Risk can be reduced if we can diversify the risk. The purpose is to get the benefit of diversification. To get the benefit of diversification, we need to select the assets with different features, different return patterns, right? So that we'll discuss in more detail in the next session. Right. The points we discussed today is that clear? Any questions? Any questions related to the points we discussed today?
So will you be sharing this Excel as well?
Yeah. I'll send the Excel sheet because with this equity valuation and bond valuation also, I will send the total Excel sheet.
Thank you, sir.
Right. Okay. Then thank you so much. So we'll continue. We'll start the new topic next day.
Thank you.
Thank you. Good
Thank you, sir.
night, sir.
See you. Good night.
Thank you, sir.
Good night.
Thank you, sir. Good night.